Here's a number I want you to sit with for a second. $148 billion. That's Warren Buffett's net worth as of right now. $148 billion. And here's the part that almost nobody talks about. He made 99% of that money after his 50th birthday. Think about that. He didn't peak young, he didn't sell a startup, he didn't get lucky with crypto or ride a tech wave. He just kept going, quietly, patiently, for decades. He started wondering what was really going on. Because everyone tells you the same surface-level story. Oh, he invested early. Oh, he's patient. Oh, compound interest. But when I actually dug into the numbers, the real timeline, I found something that nobody puts in those motivational quote posts. And that's what this case file is about. Welcome to Finance Detective. I'm your host. Let's open the case. So let's start with the story you've probably heard. Warren Buffett was born in Omaha, Nebraska, 1930. His dad was a stockbroker. He discovered a library book at age 7 called 1,000 Ways to Make $1,000. At age 6, he was buying packs of chewing gum from his grandfather's shop and selling them door to door for a profit. At 11, he bought his first stock, City Service Preferred, 3 shares at $38 each. The stock dropped to $27. He held it. It recovered to $40. He sold. Then he watched it shoot up to $200. First lesson of investing learned at 11 years old. Don't sell too early. By the time he was 14, he'd saved $1,200 and bought a 40-acre farm at 14. Okay, so far so good. Gifted kid, great start, classic Buffett origin story. But here's where most people stop telling the story. And here's where it gets genuinely interesting. Because the secret isn't the gum, it isn't the farm, it isn't even the stocks. The real secret is something so boring most people skip past it. And we're going to break it down, piece by piece.
So I pulled up Buffett's net worth by age, and I plotted it out. At 30, he was worth about $1 million. Good, right? Millionaire at 30. At 38, $25 million. That's serious money. The guy is clearly exceptional. At 50, still only $300 million. Then something happens. At 56, $1 billion. At 65, $17 billion. At 90, $81 billion. Today, at 94, $148 billion, and still growing. He made more money between age 90 and 94 than most people would see if they earned $1 million a year for the next 1,000 years. So what happened after 50? Did he suddenly get smarter? Did he find some secret investment strategy? No, he just kept the snowball rolling. Warren Buffett once described compound interest like this. The nature of compound interest is it behaves like a snowball of sticky snow, and the trick is to have a very long hill. That's it. That's the whole thing. Not a hot stock tip, not insider knowledge. A snowball and a long hill. He started rolling his snowball at age 6, and he never, not once, let it stop. Here's the number that broke my brain when I saw it. If Buffett had stopped investing at 60 to retire and enjoy life, his net worth today would be roughly $11.9 million, not $148 billion. The extra decades didn't just add to his wealth, they multiplied it over and over and over. That's compound interest. That's clue number 1. Okay, so clue 1 is time. Simple enough. But here's what I found when I kept digging. Because compound interest alone doesn't explain the scale. Lots of patient investors started early and didn't end up with $148 billion. So what else was going on? When Buffett was 25 years old, he did something most people overlook. He started an investment partnership. He went to friends and family and said, "Give me your money, I will invest it. You keep the first 6% return every year. Anything above 6%, I take 25% of the profits." Sounds fair, right? He took the risk, he did the work. But here's the thing. He was investing his skill, his time, and his brain, but he was compounding other people's money. If Buffett had only invested his own initial savings, he would have made 76 times less money over those early years. 76 times less. He wasn't just compounding his own wealth, he was using the power of other people's capital to amplify his returns. And then he did it again at a much bigger scale with Berkshire Hathaway. When he bought Geico, an insurance company, it wasn't just about Geico itself. Insurance companies hold something called float. That's money from premiums that customers pay that the company holds before it ever pays out claims. Berkshire Hathaway currently holds over $170 billion in insurance float. Buffett has been investing that float, other people's money, for decades and earning returns on it for free. This is clue number 2. It's not just compound interest, it's compound interest applied to other people's money at scale for decades.
Clue 3. The boring superpower. Clue 3 might be the most underrated one of all, because we've been focusing on what Buffett does, but his real superpower is what he doesn't. He doesn't panic sell when markets crash. He doesn't chase trends. He didn't buy .com stocks in 1999. He didn't FOMO into Bitcoin at the peak. He didn't even buy Apple until 2016, decades into Apple's existence, because he only buys what he understands. While everyone was losing their minds in 2008, selling everything, panicking, watching portfolios collapse, Buffett was buying. He called it raining gold. When it rains gold, put out a bucket, not a thimble. He bought Goldman Sachs. He bought Bank of America. He got sweetheart deals that nobody else could get because he had cash, patience, and no fear. That's not a strategy most people talk about. They talk about what he buys. They don't talk about how long he waits. Buffett's favorite holding period is, and I'm quoting him, forever. Not a quarter, not a year, forever. He once said the stock market is a device for transferring money from the impatient to the patient. Clue 3. The most powerful thing you can do in investing is often nothing. Okay, so we've cracked the case. 3 things actually made Warren Buffett $148 billion. Not one, not luck. 3 compounding forces working together. Clue 1. Time. He started at 6. He never stopped. Clue 2. Other people's money. Float. Partnerships. Scale. Clue 3. Patience. Not selling. Not panicking. Just holding. Now, you're probably not going to build Berkshire Hathaway, and that's fine. That's not the point. The point is that 2 of these 3 things are available to you right now. You might not have float from an insurance company, but you have time, and you have the ability to be patient. Here's what the finance detective recommends based on this case. 1. Start today. Not next month, not after the next paycheck. Even $20 a month invested at 22 is worth more than $200 at 32. 2. Stop watching your portfolio every day. Buffett doesn't check his portfolio when he wakes up. Neither should you. 3. Put your money in boring things. Index funds, ETFs, things that grow slowly and don't make headlines. Headlines are for entertainment. Boring is for wealth. 4. Never sell in a panic. Every crash in history has recovered. Every single one. The people who lost money were the ones who sold at the bottom. Buffett once said his wealth came from 3 things: living in America, some lucky genes, and compound interest. You may not have his genes or his luck, but compound interest, that one's available to everyone. You just have to give it time. So, $148 billion. Not from a single lucky bet. Not from a tech IPO or a viral moment. From a book about making money that a 7-year-old found in a library. From gum sold door to door at age 6. From a snowball rolled down a very, very long hill. Warren Buffett's story isn't about genius. It's about what happens when ordinary principles are applied with extraordinary patience. And the thing that gets me every time I look at these numbers, you have the same tool he used. Compound interest is not exclusive. It doesn't care how old you are. It doesn't care how much you start with. It just needs time, and it will do the rest. Case number 002, closed. If this video made you think differently about money, hit subscribe. Every week we open a new case file. Next week, we're investigating why most lottery winners go broke. Yes, really. Stay tuned. I'm the Finance Detective. Finance made simple. See you in the next case.